Hi guys, hope you're doing well. Nick here, Managing Director at Verta Property Group. So today I'm just going to give everyone a quick introduction to property bonds and loan notes, which you may have seen or come across over the years. So just want to give a very quick snapshot into what they actually are, how the model works, why the developers use them, etc., etc. Hopefully it will give you a bit more clarity on the model and give you a better understanding. So property bonds, also known as loan notes, are effectively a fixed income investment. So ultimately, you're lending money to a developer. They're going away, they're building projects, and they are repaying you your original capital at the end of the term, as well as an interest rate per annum, which is typically higher than what you would see from a traditional buy-to-let rental yield. So put very, very simply, it's lending money to a developer and they're giving you interest on that money, and then they're paying you back the original term or the original amount based on the maturity of the loan note, which might be 1 year, 2 years. It might not be a fixed time frame. It might be flexible if it's project based, but it can vary. But typically it's, a year or two. So a loan note is effectively a contract or an agreement with the developer. Is what they call a debt instrument. So yeah, that's basically how it works. Lending money to a developer, you in return for that get your interest rate, and there is varying levels of security which may come associated with your agreement. Now that might be some form of charge, first charge, second charge, debenture over assets, debenture over holding companies, personal guarantees. You often have security trustees involved as well. So there are different security packages available, and that will depend on the structure that the borrower, in this case the developer, has gone to market with. Now, why do developers use bonds to raise funds? Well, it's very quick. You can scale up very quickly as a developer if you're using private capital. So, for example, we have a worldwide network of financial advisors, of wealth managers, of other real estate agencies. We have our own investor network, which is, tens of thousands of investors. So the minute a developer has structured a loan note and bond and they're ready to go to market, they can plug into this huge network. And if the security is right and the return is right, then they can raise capital in a great scale very, very quickly. Okay. So people say, why don't they use banks or why don't they use development finance? They do in some cases. It completely depends on the project. But you've got to remember that banks, development finance, they take a very long time. There's lots of red tape. There's lots of administration. They often have to go to sites, value sites, make sure everything is sorted and in place from a formal perspective. Like they might need certain planning approvals before releasing capital. They might require the developer to put in a certain amount, or they're only going to lend, 60% of the site value or the GDV, etc., etc. There's a lot of red tape. It takes a lot longer. So it's not, what you'll often find is developers don't use one form of finance. So they're not going to say, we only use private finance. In some cases, they'll say, we'll only use development finance for this. We'll put in the rest ourselves because we're ready to go. We like this site, etc. Other times they might require private finance to arrange and purchase sites or make acquisitions without planning permission, etc., where banks and development finance wouldn't really be involved anyway. So yeah, private investors and private capital basically gives the developer the opportunity to go to market. They can move quicker, they can buy in cash, they can secure better deals, they can run multiple sites at the same time, and it allows them to scale a lot quicker. And you have to remember, developers are typically working on quite a significant margin, right? They're not in it for fun. They're doing it to make money. So if they're making a 25, 30% return on the gross development value overall, these are hefty sums that they are making. So borrowing, through a few hundred thousand, few million, depending on the scale of the developer, at an interest rate of 12% per year effectively. When you look at the back end profit that they're making, and when they're doing it on multiple sites at a time, it's very clear that this type of lending is still attractive for developers. So here's kind of a bit of elaborating on that. So banks are risk averse. They rarely want to fund early stage land or planning costs, which is what I mentioned a second ago. Approval can take months. As I mentioned, if a developer wants to raise funds and they work with a company like ours, they can immediately plug into a huge global network of direct investors, of other financial firms, wealth managers, real estate agencies, accountants, lawyers, solicitors, who all know and can tap into high net worth individuals. And as a result of that, they can raise capital exceptionally quickly without all the headache and due diligence that banks go through. And another one, which is I kind of touched on as well, is that they're never going to lend on 100% of the site value, right? So let's say a developer is working on 10 sites. They might secure development finance that might be 60, 70% of the value of the build. And then the developer might have to put in 10, 20%. So if they're doing that across 10 sites, they're tying up their cash very, very quickly. And if they're using private finance, it enables them to stretch out. They might be able to do 3, 4 sites more than what they wouldn't do if they were just funding it all themselves. So yeah, it just allows for scale. That's probably the key concept I would take to mind as to why developers would use private finance over traditional finance on occasions. Now, I'm not going to go into this too much, but I kind of touched on this a minute ago. There's different layers of cash, let's say, that's required to build a site. And depending on where it sits, this might be mezzanine or bridge finance. So the developer's putting in equity, so they might have to put down a deposit on a site to acquire it. Senior debt is what you call bank finance. These typically take a fair charge on the particular site. So that's going to cover your development costs effectively. So there's still often a margin that's required and a funding gap where private finance might come in handy as well. So as you can see in this example, there's 3 layers of financing being used, and you might have a first charge here and a second charge. So it's often a combination and creative financial structures that are used by these developers. It's not like, they're doing a site, they need 2 million quid to do it. Oh, we'll go to market and we'll get all 2 million quid from the investors. It doesn't typically work like that. And why would bond investors do this? So they are earning a higher return. So this is developer grade profit margins we're talking about. We're not talking about a 3.5% net rental yield from buying in London. And, you're not going to have charges. You're going to have your fixed return, so you know what you're going to earn, when you're going to earn it, over what time frame, and it gives you the opportunity to partner with a developer that has, in most cases, quite an extensive track record. They've got experience, they've got expertise, they've got the supply chain in place, they've got the contractors there, they've got the marketing and branding, etc., etc. So it can be a really, really good option for investors, which is what I've mentioned here. You've got the yields, you've got the exposure to the UK market without having direct ownership or having to pay stamp duty. Great for investors looking at short-term plays. The market in the UK, believe it or not, in the next 3 years might pick up significantly. It might be a touch longer than that, but there is the opportunity to, rather than going in and deploying funds into traditional buy-to-let, they might want to wait for interest rates to come down. Just things like that, really, where investors might want to put their capital to work, but they don't necessarily want to acquire a full buy-to-let property, and obviously for personal reasons as well. Security structure, as I've mentioned this, typically there'll be a multi-layer security structure available for investors, security trustees involved, personal guarantees, charge over assets, debentures over companies, etc., etc., and the returns, which I've touched on already. Kind of the benefits you should be coming to terms with now. What else would I mention from this list? Documentation, that's a good one. So the level of due diligence we supply will be significant for any bond that we're working on. So, we're going to look at the developer's full portfolio and project book of what they've got happening at the moment, how much debt and equity are in those deals, what's the balance and the ratio of that, what's that across the full profile, what lenders have previously lent to them, because that's a good sign that they're a credible developer if large-scale lenders are deploying capital. What are the profit margins been in their previous sites? How many sites are they working on? What's the timeframes and the schedules? Are they adhering to what they originally expected? Have they raised capital before? Like a lot of this stuff we'll assess and we'll look at and we'll go, this is a, considering the risk-reward profile, this is a, viable model. We don't claim to be the development experts, but it's, once you go through the legal pack and you look at the information memorandum, you cover off frequently asked questions, you look at the personal guarantees that are in place, you look at the asset book, etc., etc. You can build up a pretty good picture and make a judgment call on whether someone is credible and whether they're worth working with. So there are lots of benefits. We've touched on these already. Cool. So hopefully that gives you an overview, guys. The idea is to explain the model more than sell the model, so to speak. So developers are using these bonds or loan notes to raise capital quickly, not have to deal with developer red tape. They can scale up a lot faster. They can diversify across multiple sites. They can put in less of their own money, and they can move with breakneck speed in getting to investment levels. You know, you might have one investor that's, you know, likes to look at them and puts in 3 million quid. So it's that's a couple of reasons why they would use them. But ultimately, what you need to know: bond and loan notes, they are a formal legal agreement with a developer to borrow capital for a certain period of time based on a certain interest rate, and then the maturity of that loan, you are paid the original balance back. That's put it in simple terms. Just the same way as your friend said, look, we're doing an extension, we want to do a loft conversion, we need 10 grand to do it. Can you lend us 10 grand and we'll pay you, 11 grand back? Pretty much the same, except with a much more substantial development partner who has a track record, and you have the legal entities involved, all the contracts drawn up, and that layered security structure as well to make it more of a robust and scalable model. But I'll leave that there, guys. Any questions, just let me know. And that's Nick, Verta Property Group. Cheers.